Todd VanDenburg with VanDenburg Capital Management and the Uncommon Sense Update. Greetings and thanks for watching. So last week we had another decent week in the markets, but I'm going to skip right over market performance and cut right to the chase on the big news item from last week, and that is on Friday it was released that the House and the Senate Reconciliation Committee have come up with a final tax bill that is going to probably be up for a vote this week, and that'll be really interesting because there's a whole lot of stuff in it. I'm going to cover a couple of items. The legislation that got out of committee is almost 1,100 pages. I haven't read all of it, but I've read big chunks of it. So I'm going to do something here today that I don't normally do, and you'll see me glancing off every once in a while to refer to my notes because there's a lot of information here. I'm going to cover a couple of highlights. First thing, tax rates. So there's going to be 7 different tax rates. They're all progressive, so the more you make, that extra amount that you make might be taxed at a higher rate. But in general, for most middle-class Americans, it's going to be a reduction in tax burden. What I don't like about it is that at certain points, the effective tax rate jumps rather dramatically, like from 12% to 22% and from 24% to 32%. So what that says is that if you go to make a little bit of extra money, work some overtime, that extra money that you make, you might find the tax burden on that money might be substantially higher than what you're used to. That's sort of a disincentive, but it is what it is. In general, even with these tax rates, most middle-class Americans come out ahead. On the deduction side, there's quite a few changes. They're going to eliminate most deductions and instead replace them with an increased standard deduction. So roughly $12,000 per person of a standard deduction as opposed to roughly $6,000. So for a married couple, that can make for a pretty big standard deduction. It's intended to offset the elimination of some other deductions that you might take, and again, in general, for the middle class, for most middle class Americans, that's going to be a net positive. They're going to cap the state and local tax at $10,000. So property taxes, things like that. If you have a high property tax bill, that's going to be capped at $10,000 of deduction. But that doesn't impact most people. It impacts a lot of people in high cost of living and high taxation areas. But most middle class Americans, it's going to be a net positive. The deduction of mortgage interest, so homes purchased prior to December 15th of 2017 are grandfathered in, so they still get to deduct the home mortgage interest up to the current $1 million limit. Homes purchased after December 15th, it'll be a $750,000 limit. So we should look forward to that. Again, in high cost of living areas, that could potentially have an impact in some areas. But again, most middle-class Americans won't even notice that. What they did do is many of these things are set to expire in 2025. I'm not going to list them all right now, but a lot of people are going to talk about how in 2025, it's going to be a great deal for the wealthy and a horrible deal for the working stiff. And my view of how these things typically work is as we get closer to 2025, we're going to find Congress likely going to extend many of these things. They may not, but if history is any indication of what we should be looking forward to, we should see that Congress extends many of the things that are set to expire in 2025. So I'm not going to worry too much about that right now. I am going to just focus on what's it going to look like for most people in 2018. Also increased is the estate tax deduction. It's going to be increased to $11.2 million indexed to inflation per person. So that now means that a husband and wife get $22.4 million of estate tax-free money to pass on to their heirs. That pretty much puts it out of touch for most Americans. So again, that's good for most people in that they're not going to be subject to an estate tax. Some things that aren't in the bill that we're actually happy about. There was a rule that was being thrown about called the FIFO rule, which was going to require that anytime you made a sale of an investment, if you'd purchased that investment over time, dollar cost averaging or whatever, they were going to tax it on a first in, first out basis. So the stuff that you bought a long, long time ago, that's the stuff they assumed that you sold first. That didn't make it into the final legislation, and we're actually happy about that. Also in the final legislation, the standard exemption for the sale of a personal residence. There was some talk that that was going to be abolished, but that was not touched. So you get $250,000 per person of the exemption there. So there's going to be more to this. Again, it's an 1,100-page bill. We're going to hear a little more about it in the coming days. But in general, it is pretty good for middle-class America, and which means it's going to be pretty good for likely publicly traded companies, which means we are looking forward to it hopefully being also good for the stock market. You'll be hearing more from me in the future about what this tax bill actually means, assuming that it passes here in the next week or so. So be on the lookout for that. It's, good times ahead if this bill actually does what it's supposed to do. One big concern, and I'll only spend a couple of seconds on this. One big concern is there's nothing in this bill that has anything to do with getting our cost, government spending under control. We have a $20 trillion debt, and this does nothing to address that. The fundamental premise of this bill is if we can increase the gross domestic product, that there will be more tax revenue coming into the federal government as a result of that increased economic activity. And if that happens, then that should squeeze the deficit. That's a big ask, but we'll see. The GDP for 2 consecutive quarters has been over 3%. It's estimated in the fourth quarter that it should be over 3% as well. If that happens, it would be the first time in over a decade that we've had 3 consecutive quarters of 3+% GDP growth. So if the GDP growth does generate enough additional activity to give the federal government more money, and that squeezes the deficit, then our deficit debt problems may not be as a near-term concern as we've been concerned about, over the past 6 to 10 years. So we'll be watching it really closely. We think you should too. This is really important stuff. It's going to impact every American. And if anybody has any questions, you can certainly reach out to us. We'll be happy to answer any questions you might have. That was your lengthy moment. I hope you enjoyed it. If you did, give us a like, give us a share. We certainly appreciate it. And we'll be back in a couple of days with another Uncommon Sense moment. Thanks for watching.